So who do we recommend managed funds for? New investors, or the baby boomers, or those who are well-heeled, well-experienced in market investment?
I mean, for mutual funds, it's not precluded to any class of investor, because at the end of the day, even the more experienced investors or the more seasoned investors can have it as part of their portfolio. I mean, you can invest in an equity mutual fund as part of maybe a percentage of your portfolio, knowing that the rest of your portfolio, you maybe have the time to invest in that. And all you really need to do is to check the historical returns. That way you can gauge the skill of the manager. Obviously, you have to take into account the fees of the fund, which are very important in calculating your actual return, because yes, a fund is saying 13% return, but the fees on that might be as high as 2-3% on an annualized basis. You're basically just taking that, and that's about 10%. So I mean, you need to be wary. So I don't believe that any particular class of investors is precluded. New investors coming into the market that don't have the time to really sit down and look at the market on a continuous basis, or don't want the hassle of continually reinvesting their money, can go into that, while seasoned investors can also look at that as well and make it a part of their portfolio allocation.
Who are the big boys here? The PFAs, the usual deep pocket guys, the insurance?
Now, I mean, more recently, what you find is that PFAs have been allowed to adjust to invest in alternative investments. When I say alternative, there are now more allocations through Fund 1 to Fund 4 for equity and associated investments. So you see PFAs now being able to invest more in mutual funds. But typically, the market has been more lean towards retail investors than institutional investors.
So when the market is generally in a downbeat mood and the economy itself is struggling, how much burden does a fund manager bear under this circumstance? Because we've all given you folks our money. We expect some return at the end of the day.
That's what I'm saying. So it's part of the manager's job to actively manage a mutual fund, an equities mutual fund. I mean, when it comes to money market, it's pretty straightforward. You just look for assets that the typical investor might not have access to, and make sure you invest at the highest yield possible for the amount of funds you have. But on the equity side, when the market is downbeat, when like in your example, the economy is just chugging along, the truth is that an actively managed fund is expected to outperform than a passively managed fund. So, I mean, it goes back to the manager's skill and the manager's timing and the general performance of the fund. So, I mean, an equity mutual fund is expected to do better when market is down if it is actively managed.
But that's what investors, that's what we are paying you folks 2 to 3% for, isn't it? That's a lot of money.
It's not 3%. It's total 3%. I mean, those fees include the fund manager's fees, the custodian's fees, the trustees' fees, credit rating fees. I mean, there's quite a few fees beyond the fund manager's fees. Typically in this market, the fund manager's fee doesn't exceed 1.5%.
So there are many parties. There are other parties to the entire managed fund. So everybody has a take. Yeah, you got to pay folks keeping an eye on your money. So what's the playbook for this year? How do you think the market reading and economy expectations will be for mutual funds in the new year?
I mean, it's quite a positive one. I mean, we don't expect the economy to retract significantly. We expect a slow but positive growth for the year. I mean, GDP growth has been put between 2 to 2.5% for the year. And equities, we also expect equities to look up. I mean, the major drag to the equities market in recent times has been the political risk driving capital flow reversals. Once we make it past that point, with the economy moving forward and with policy direction also positive, what you will find is that foreign investors should come back into the market. That should also drive domestic participation. And all of these things tend to bode well for the equities market. You add to that the possibility of new listings, stable macroeconomy. All of these things are positive, and so mutual funds will do well. So, I mean, it's about ensuring that you're in a position or in a fund that you know or have assessed that has the niche to take advantage of market opportunities as they come. I mean, for the first half of the year, I would expect more investments into money markets, mutual funds than equity mutual funds, but there should be a reallocation in the second half of the year, provided that we move past this risk and this risks on the horizon.
Okay, well said, well said. Thank you very much, Jeremy Odongaro, associate and team lead in terms of research at AfriInvest, one of the investment bank and securities trading firm on our markets today. Thank you very much. Have a great day, and we appreciate you being here. Let's touch base with the marketplace. Remind you this notice from CNI Leasing PLC to the Nigerian Stock Exchange that Abraj, the private equity firm, of course, which is winding up in the Middle East, says is Eros Africa Fund, which has $10 million in CNI Leasing PLC, is now converting that $10 million, which was a loan stock, into equity. CNI Leasing says that will now enable the company, CNI Leasing, to position itself favorably for additional capital raising from the market in the first quarter of this year. So expect from CNI Leasing PLC to go for another round or a round of capital raising before the end of this quarter, which is March the 31st. What that means is CNI is also converting, doing share reconstruction, or what you call consolidation, if you want to use another phrase, 4 existing shares of you shareholders into one share. That is what you call the share reconstruction that CNI Leasing is just announcing everyone. If you're in the market, I'm sure you're on top of this as it's happening. Let's take a break. We'll be right back.